Another important question for final exams is mutual funds, definition of mutual funds, and types of mutual funds. Mutual funds are a very important form of NBFIs for promoting as well as mobilizing financial savings. They also act as important investment institutes, especially for the corporate sector. The term mutual fund is commonly used for such NBFIs in USA and Canada and is now increasingly used in India too, whereas similar financial institutions are called unit trusts in UK. It is just a matter of historical accident that when the first mutual fund of this kind was set up in India in 1964, it was named as Unit Trust of India. In recent years, since 1988, such institutes have invariably carried the generic title of mutual fund in their names. Mutual funds are fast becoming an important medium for mobilizing savings of the community, particularly of the middle class and small investors, as they supposedly provide benefits of portfolio management of stock market securities to their shareholders. A mutual fund does it by minimizing risk and raising its rate of return through portfolios diversification. Having approximate mix of securities, watching expertly market developments all the time and turning over the portfolio to benefit to the maximum for ever changing market scene. Other things being the same, the gains to the shareholders of mutual funds generally depend upon the quality of its portfolio selection and management. Now, question arises, what is mutual fund? Mutual fund is the trust that pools the savings of the number of investors who share a common financial goal. The income earned through investments and the capital appreciation realized by the scheme are shared by its unit holders in proportion to the number of the units owned by them. Types of mutual fund schemes and products are as under. There are wide variety of mutual fund schemes that cater to your needs wherever whatever your age, financial position, risk tolerance, and return expectations, whether as the foundation of your investment program or as a supplement. Mutual fund scheme can help you meet your financial goals. In terms of execution and operation, the mutual funds can be classified into the following categories. By structure, there are three schemes. Open-ended schemes, these do not have a fixed maturity. You deal directly with the mutual fund for your investments and redemption. The key feature is liquidity. You can conveniently buy and sell your units at net asset value related price. In an open-ended scheme, the corpus size is not determined in advance and subscription is always open. Shares and units are repurchased at periodically announced repurchase rates. The purchase price and buyback price are based on the NAV of fund which are announced regularly. Unit Scheme 1964 of UTI ULIP Children's Growth Fund, Can Banks, Can Gilt and Can Sigo are the few examples of open-ended mutual funds. Close-ended schemes that have a stipulated maturity period ranging from 2 to 15 years are called close-ended schemes. A person can invest directly in the schemes at the time of initial issue and thereafter he can buy or sell the units of the scheme on the stock exchanges where they are listed. The market price at the stock exchange could vary from the scheme's NAV on account of demand and supply situation, unit holders' expectations, and other market factors. One of the characteristics of the close ended schemes is that they are generally traded at a discount to NAV. NAV is net asset value. But closer to maturity, the discount narrows. Some close ended schemes give a person an additional option of selling his units directly to the mutual fund through periodic repurchase of NAV related prices. SEBI regulations ensure that at least one of the two exit routes are provided to the investor. UTI's master share, LIC's Dhanshri, can banks can share, can stock, etc. are examples of closed end mutual funds. Interval schemes. These combine the features of open ended and closed ended schemes. They may be traded on the stock exchange or may be open for sale or redemption during predetermined intervals at net asset value related prices. By growth investment objectives, these are as under: growth schemes. These schemes aim at providing capital appreciation over the medium to long term. These schemes normally invest a majority of their funds in equities and are willing to bear short term decline in value for possible future appreciation. These schemes are not for investors seeking regular income or needing their money back in the short term. Its examples are SBI Magnum, CanShare, etc. These schemes are ideal for investors in their prime earning years, investors seeking growth over the long term. Income schemes. These schemes aim at providing regular and steady income to investors. These schemes generally invest in fixed income securities such as bonds and corporate debentures. Capital appreciation in such schemes may be limited. Its examples are Can Stock, Can Gilt, SBI Magnum. Balance schemes. These schemes aim at providing both growth and income by periodically distributing a part of the income and capital gains they earn. They invest in both shares and fixed income securities in the proportion indicated in their offer documents. In a rising stock market, the net asset value of these schemes may not normally keep pace or fall equally when the market falls. These schemes are ideal for investors looking for a combination of income and moderate growth. Money market schemes. These schemes aim at providing easy liquidity, preservation of capital, and moderate income. These schemes generally invest in safer, short term instruments such as treasury bills, certificates of deposit, commercial paper, and interbank call money. Returns on these schemes may fluctuate depending upon the interest rates prevailing in the market. These are ideal for corporate and individual investors as a means to park their surplus funds for short term periods or awaiting a more favorable investment alternative. Other schemes. These are as under: tax saving schemes. These schemes offer tax rebates to the investors under tax laws as prescribed from time to time. For example, equity linked savings schemes and pension schemes. Recent amendment in the Income Tax Act provide further opportunities to investors to save capital gains by investing in mutual funds. Special schemes. This category includes index schemes that attempt to replicate the performance of a particular index, such as the BSC Sensex or the NSC 50, or industry specific schemes which invest in specific industries, or sectoral schemes which invest exclusively in segments such as A group shares or initial public offerings. Index fund schemes and ideal for investors who are satisfied with a return approximately equal to that of the index. Sectoral fund schemes are ideal for investors who have already decided to invest in a particular sector or segment. Offshore mutual fund schemes. The floating of offshore mutual funds is an excellent way of bringing overseas funds into the country. The corpus of these offshore funds is raised abroad and brought into India for portfolio investments. These funds have to contend with both currency risk, namely exchange depreciation, and country risk, like disintegration of Yugoslavia. For the global investor, UTI has floated offshore funds, India Fund, and India Growth Fund. Higher the return one seeks, higher the risk he should be prepared to take.